One company just erased 20 years of assumptions about who controls the chip industry, and it happened. One company just erased 20 years of assumptions about who controls the chip industry, and it happened without a single Nvidia GPU in the room. In the first 6 months of this year, a group of little-known Chinese equipment makers didn't just grow. They doubled. Their stock prices didn't rise 10% or 20%. Some of them went up over 100%. And almost nobody in the West is talking about it. Picture this. You're an investor scanning global markets in July 2026, looking for the biggest winner in tech. You'd expect Nvidia. You'd expect Apple, or Microsoft, or some AI darling in California. But the single hottest corner of the entire semiconductor sector right now isn't in Silicon Valley. It isn't in Taiwan. It's a cluster of factories in Shanghai, Beijing, and Hefei, building the machines that make chips, not the chips themselves. And they're on fire. Here's the number that should stop you. 14 major Chinese semiconductor equipment firms, companies most people have never heard of, just posted combined revenue growth of roughly 35% year over year. Not 35% over 5 years. 35% in 12 months across an entire industry segment. And it's accelerating, not slowing down. Now hold that thought, because it gets stranger. In the first quarter of 2026 alone, that same group's revenue was up around 32% compared to a year earlier. That's already remarkable for heavy industrial equipment. But their combined net profits in that same quarter? Up an estimated 61%? Profit is growing almost twice as fast as revenue. That's not a company getting lucky on one big order. That's a sign that an entire supply chain is running hot, with pricing power, better margins, and factories that can barely keep up with domestic demand. So who are these companies actually making these numbers? Let's name them, because anonymity is part of why this story has stayed under the radar. Nora Technology Group. Think of it as China's answer to a slice of what Applied Materials does, building etching, deposition, and cleaning equipment for chip fabs. AMEC, Advanced Microfabrication Equipment, China, a major player in plasma etch tools, the machines that carve microscopic circuit patterns into silicon wafers. Piotech, which builds thin film deposition systems. Watsing Technology, which makes wafer polishing and cleaning equipment. And smaller but fast-growing names like King Semi and Wuhan Jingsei, feeding niche steps of the chip-making process. None of these are household names. All of them have seen their share prices climb somewhere between 70% and over 100% so far this year. You're probably asking the obvious question. Why now? Why this specific corner of the industry, and why this violently, this fast? The answer traces back to a single blunt strategic reality that Beijing has been building toward for years. If you can be cut off from foreign chip-making tools, you are not sovereign, you are hostage. And China has been cut off. Export controls from the United States, tightened repeatedly since 2022, and again through 2025, have restricted the sale of advanced lithography, etching, and deposition equipment from companies like ASML in the Netherlands and Applied Materials, Lam Research, and KLA in the US. For years, Chinese fabs depended heavily on this foreign equipment to make anything beyond the most basic chips. That dependency is now treated in Beijing as a national vulnerability on par with energy security. So the response has been massive, coordinated, state-backed spending to build a domestic alternative, from the lithography tools themselves down to the polishing pads and gas delivery systems around them. This isn't a startup story. This is an industrial policy story, playing out in real earnings reports. Here's where it gets bigger than most people realize. This isn't just about phones or laptops. Every advanced chip, the ones powering AI data centers, electric vehicles, missile guidance systems, satellites, starts at the equipment layer. Before a single transistor exists, someone has to build the machine that etches it. Control that machine, and you control the starting line for everything downstream. That's why Beijing isn't subsidizing chip designers first. It's subsidizing the machine builders first. Get the tools right, and the chips follow. And the money backs this up in a way that's hard to dismiss as hype. According to disclosures and industry estimates, China's domestic chip makers have been directing an increasing share of their capital expenditure. Some estimates put it above 70% for certain leading-edge and mature node fabs, toward domestically produced equipment compared to a small fraction just 5 years ago. That's not a marginal shift. That's a supply chain being rebuilt from the inside, one wafer fab at a time. Now here's the part that should genuinely surprise you, especially if you think you already understand the chip industry. Nvidia, the most valuable, most talked about chip company on Earth, has almost zero direct exposure to this specific rally. None of it touches Nvidia's business model. Why? Because Nvidia doesn't manufacture chips. It designs them and outsources the actual fabrication to Taiwan Semiconductor Manufacturing Company, TSMC, which then buys its equipment from ASML, Applied Materials, and the other Western tool makers. Nvidia sits at the top of the value chain, selling finished silicon. This rally is happening 2 full layers underneath Nvidia, in the machines that make the machines that eventually might make a chip Nvidia designs, except, critically, not in China, because US export rules already block Nvidia's most advanced chips from being sold there anyway. So you have this almost paradoxical situation. The most dominant chip brand on the planet is essentially a bystander to the biggest chip-related stock rally of the year, because that rally is about domestic Chinese self-sufficiency in a market Nvidia has already been pushed out of. That raises the real stakes here, and this is where the story stops being just about stock charts. The global semiconductor equipment market has, for decades, been dominated by a small handful of companies: ASML with its near monopoly on extreme ultraviolet lithography, Applied Materials, Lam Research, KLA, and Tokyo Electron. Together, these firms have controlled the vast majority of global spending on chip-making tools. If Chinese equipment makers keep growing at anywhere close to this pace, they're not just serving a captive domestic market anymore. Over time, they start competing for global market share, especially in mature, node chips, the unglamorous but essential silicon that runs cars, appliances, and industrial machinery. That's the long game. And it explains why Western toolmakers have been watching this rally nervously, rather than dismissing it. Applied Materials and Lam Research have both flagged, in recent earnings calls, that a resurgent, subsidized Chinese equipment sector is now a structural risk to their long-term market position, not just a one-year blip. But before you assume this is a guaranteed changing of the guard, here's the tension nobody's resolved yet. Stock prices don't always track reality cleanly, especially in sectors flooded with state support and patriotic investor sentiment. 100% stock gain can mean genuine breakthrough performance. It can also mean a speculative bubble, inflated by retail investors piling into anything labeled chip self-sufficiency as a patriotic trade. Right now, both explanations are plausible, and the difference between them will only become clear when the next full earnings season lands and analysts test these numbers against forward guidance, order backlogs, and whether that 61% profit growth is repeatable or was a one-time spike from a handful of large domestic orders. There's also a technology ceiling to be honest about. Even with all this growth, most of these Chinese firms are still concentrated in mature and mid-range chip-making equipment, not the bleeding-edge extreme ultraviolet lithography machines that only ASML can currently build, machines that cost over $150 million each and take years to master. China still doesn't have a domestic equivalent of that specific machine in mass production. So this rally represents massive progress in self-sufficiency for a wide swath of the chip supply chain. But it is not yet proof that China has closed the gap at the most advanced edge of the industry, the edge that determines who builds the next generation of AI chips. So where does that leave you, watching this unfold from the outside? You've just watched an entire tier of the chip industry, the equipment makers, surge in value based on a bet that China can build its own semiconductor future, independent of Washington, Amsterdam, and Silicon Valley. 14 firms, 35% combined revenue growth, 61% profit growth in a single quarter, and stock prices that have in some cases more than doubled. All while the world's most famous chip company, Nvidia, watches from a completely different layer of the industry, largely irrelevant to how this specific story plays out. The open question, the one that will actually decide whether this was a historic inflection point or an overheated trade, comes down to earnings season. When these companies report their next full results, will the growth curve hold, or will it flatten the moment the initial wave of subsidized patriotic domestic orders works its way through the system? If it holds, you're watching the early chapter of a genuine restructuring of the global chip equipment industry. If it doesn't, you're watching a very expensive lesson in how national pride and stock prices don't always move at the same speed as real technological progress. Either way, the machines being built right now in factories most people can't name, in a country most Western chip narratives still underestimate, are going to decide a lot more about the next decade of technology than most people are paying attention to. If you want to actually understand where the chip war goes next, subscribe. because this story is only getting started.